Good afternoon, everyone, and welcome to the O'Hare Wealth Management Quarterly Chart Party. This is Jerry Jones. I'll be joined by John O'Hare and JJ O'Hare from our team. We really appreciate you taking time out of your Thursday to join us. Pardon me. Uh, Once again, this is our quarterly chart party. We're going to summarize things from the past 3 months, 6 months, and give you an outlook for the remainder of the year. This falls under the category of what we call our three things we do for our clients. We are your go-to advisor on everything financially related. We optimize your wealth with the largest toolbox and the people who know how to use the tools in the box. And we provide you with a high level of service with integrity. During today's call, if you have any questions, we truly encourage you to submit those. But first, we also want to remind those of you who are located here in Wisconsin, you are cordially invited, along with the guest, if you feel free to bring one along, Wednesday, August 7th at 6:35 p.m. at Capco Park in Mequon, Wisconsin. We'll have the First Base Club private deck rented out that evening. Food and beverage will be provided. Once again, you are encouraged to bring along a guest and enjoy some social time with the O'Hare Wealth Management team, along with our guests and along with our clients and their guests. So once again, mark that down, Wednesday, August 7th at 6:35 p.m. Please RSVP by July 31st to service@o'harewealth.com or the number on your screen, 414-644-0062. Should be an exciting and fun time. Moving on to today's call, if you have any questions, and I'm sure there will be some that will come up, this call is longer than our normal Thursday call. Normally, that's about 15 minutes. Today's will stretch about 45 minutes and is being recorded for you to view at your leisure. But if you do have questions, submit those to service@o'harewealth.com, or you can text at 414-644-0060. Once again, that's 414-644-0060. With that, we've got a lot to unpack today, so I'm going to turn it over to John and JJ. Take it away, guys.
Great.
Thanks for joining us.
We hope you come out and visit us, the Chinooks game. It's not summer without a little baseball.
Nope. You're up first, right? Or do you want me to go first?
I think I'll go first.
Okay,
Anyway.
all right.
Yeah, it's probably better that way. Thank you for joining us today. We're going to have first half of the presentation on the economy, what's going on with the U.S. economy. The second half will be on markets, talking about what the stock market might or might not do and the bond market. I have really three themes today. The first one is about GDP and the growth. It is slowing down. Secondly, slowing growth means lower inflation. Third, it's going to give the Federal Reserve an opportunity to start lowering rates, which is what we're all hoping for. In addition, it appears at this point that the Federal Reserve might have accomplished a soft landing with their rate increases. We were scared to death 2 years ago of a hard landing, and it hasn't happened. So I think that is good news. But let's talk about GDP. If you look at the left-hand side of this graph, this is the dotted blue line is the trend line growth for the U.S. economy. It's 2%. Now that's real growth. That's after you subtract inflation. So if the economy grows at 6% and we have 4% inflation, the real growth is 2%. You can see we followed that trend line for a long time. COVID, we went down sharply, but came right back to it. But if you look at the smaller box up in the corner, it talks about the last 4 quarters of GDP growth. And you see in 23, we had 2%, then 5%. At that point, I think we had 4% plus inflation. So you're looking at almost 9, almost 10% GDP growth. The third quarter ended strongly above trend at 3.4. But look at the first quarter of this year, 1.4%. We're slowing down. That's what the Fed has been trying to engineer, is a slowdown, because our trend line is 2% growth. We go at 5% growth, we're going to have high inflation. So the Fed is getting what they want. Let's go over the components of GDP. We've talked about this in past presentations, but it's a good reminder. There really are five components, general components. Starting at the top is housing. I think everybody knows housing has slowed down a lot because mortgage rates have gone up. And guess what? Less people are buying new homes or existing homes. And if they're not buying existing homes, they're not remodeling them, they're not buying new appliances and everything else. So that slows the economy. Investment X housing, that's manufacturing, office buildings, warehouses, things like that. That's doing okay. There is one sector there that is doing very strong, and that's manufacturing, construction. And I'm going to show you a slide on that later, because long term, that's very bullish for the US and the North American economy. Government spending, we got a lot of that over the last few years. That's slowed down. It's still a net tailwind helping us a little bit, but not like it was 2 years ago. The consumption, which is the consumer, that's the big one. That's 2/3. I'm going to talk about this. We're slowing down. The consumer is getting stretched. And you probably hear about it. McDonald's and some of these fast food places have $5 meals again. It's because they're not getting enough traffic. Prices have gone up so much, people are eating more at home. Target had to lower prices on 4,000 items because they weren't getting enough traffic. So this is putting pressure. The consumer clearly is under pressure. Exports, we don't talk a lot about that. It's always slightly negative. Right now, the high dollar is not helping us. But if the Fed lowers rates, typically we get a lower dollar, and that'll help our manufacturers. But let's look at earnings growth for the S&P 500. And I think this chart's very interesting. We bumped into this earlier this week, looking at EPS growth going back 4 years. And I want to note something here. End of last year, early this year, everybody's been waiting for a recession. Remember in 22, we're definitely going to have a recession, maybe a hard landing. Then all through 23, we talked about another recession. It never happened. No one's even talking about it anymore. Our conclusion, the reason they're not talking about it, it already happened. We did have 2 negative quarters of GDP growth back in 22. And remember, the market started falling sharply in 22 and fell all year until it bottomed in the fourth quarter of 22. The market looks forward. What the market was telling us then is that profits were going to be down. And guess what? The 23 profits were down and flat for the year. So the market correctly told us that you were going to see a profit slowdown or a profit recession. In 23, the market recovered, and everybody wondered, why did it recover? We didn't have the recession yet. Well, we sort of did. Look at the numbers. And the market, again, looking forward, took the market up again, and early this year got back to the old highs. Why? Look at the far right side of this graph. We're looking for 9% earnings growth in the second quarter, 8% in the third quarter, and 14% in the fourth quarter. Long-term trend is 6 to 7%. So 8, 9, 14, these are really good numbers. But this confirms our thought process that we already had the recession and we're in a recovery mode. Now, we've had the strong recovery already, and we're going to start to slow down to a normal pace of GDP growth. We're not looking for a recession. Let's talk about, this is an extra slide we threw in because our long-term theme is very bullish on North America and the US. And one of those themes is onshoring or reshoring manufacturing here. And just read an article in the Wall Street this week about the former GE Appliances. It's owned by a Chinese company now, but they moved most of their operations back to the US. And they did it because of the supply chain issues during COVID. And it's worked out very, very well. But when you look at the spending line, you can't help but notice on the right side, there's an enormous jump. We were trending for years between 40, 50, 60 billion, maybe 80 billion a year in construction spending. Now we're at 240, almost triple what we were pre-COVID. That is the reshoring and onshoring. That's good news for the economy. If you build plants, what do you got to do? You got to hire people, you got to put in equipment, start making stuff and shipping it. So that's good news, and that's a long-term trend. But let's look at how the consumer is doing, because as we said, consumption is 2/3 of the economy. I've got some good news and bad news here. Some of the good news is the balance sheet. It is still very strong. When we look at the total assets, this is for all consumers in the United States, got 181 trillion with a T of assets and only 20 trillion worth of debts. So the net worth, I think this is a new record high at 161 trillion. Part of it is the stock market's done very, very well in the last 5-6 years. And housing, everybody knows housing's up 25% in the last 4 years. Typically, when you have the rise in financial assets and housing, you get a wealth effect. The wealth effect is you spend more money because you feel wealthier. It's not happening as much this time. And the big reason is twofold. One, with financial assets, they're usually tied up in your 401k plans or pensions. And the individual stocks are mostly held by the top 15% of the country. Housing, though, 2/3 of us own houses. So you think, hey, you got more wealth, let's spend it, let's borrow some money on my house. Well, we did that 20 years ago when rates were 3-4%. Now they're 8-9%. So people aren't borrowing. So we're not getting the extra kick out of that we used to. Now, if you look at the consumer debt load, this is still good news. Debt servicing as a percent of disposable income is still near record lows ex-COVID over the last 40 years. So the consumer can take on a little more debt, but here's the bad news. They're already being stressed by that. When we look at delinquencies, it's not good. There's 3 lines here. The student loans we're going to ignore because they've been postponed for a while. That will be a headwind when they have to start paying them again. But autos and credit cards, delinquency rates are now higher than pre-COVID. They're not as high as the great financial collapse and housing crisis, but they're definitely up, which shows spending is getting squeezed. And again, this is why things are slowing down. The other thing that's happened, and this is very important, the Fed wanted to engineer a soft landing, a slowdown, and they didn't want unemployment to go to very high levels. And many economists 2 years ago, 3 years ago, said unemployment's going to have to go to 6 or 7% to get inflation down. The Fed said, not really. What we need to do is slow down this labor demand because we were in a white hot market. The left side of this graph shows that 3 years ago we had 12 million jobs outstanding. We only had about 6 million people unemployed. So there was 2 jobs for every person. Now you see where the dot is today, there's 8 million. So 1/3 of those jobs are not out there anymore. That's a cooling labor market. We're getting back to pre-COVID levels. Also on the upper right-hand side, that's the quit rate. You notice it peaked. People quit more often when the jobs are plentiful and you get fat raises to leave. That's not happening anymore. In fact, there's an article in the paper about that today in the Wall Street. So the quit rate is declining. And on the lower half, layoffs are climbing. They've climbed quite a bit since 2020. So the consumer is not feeling as comfortable about his job or her job as they did 2 years ago. What does that mean? They're going to be more cautious about their spending. Again, another reason, another headwind for the economy. Speaking of how the consumer feels, this is a survey they do of consumer confidence and the stock market for years. To make this easy, because the graph is kind of all over the place, if you look at the dotted blue line in the middle, that's an average result. The average is 85. This goes back almost 50 years. If you look at the blue dots at the top and the bottom, you notice there's a number underneath them. That number is what the stock market does 12 months later. So if you look at the far left, August of 72, people were happy. They were feeling very good about the economy, and the market was down 12 months later. And if you notice those top blue dots, almost every time the market is flat or down later. Why is that? Of course, everybody's very excited about the economy. The reverse is true. If you look at the bottom, every time we bottomed on the survey, the market's gone up double digits, 20% plus, which is fantastic. But it's like everything, everybody's in a bad mood and they don't want to talk about, they don't want to talk about good things and buying things, but it's a great time to buy the stock market. We brought this chart out in the fall of 22 to show people June of 22 was the worst reading ever on this chart. And we had to ask ourselves back then, how did you get the worst reading on this survey ever? When you look back, it was worse than the housing crisis, and it was worse than the energy crisis. We have two of them in the 70s. I grew up during those. It was much worse then than June of 22. The difference in June of 22 is we have a generation of individual investors who have never experienced true inflation, and inflation was crushing them. And they were very disappointed in the economy because we had full employment. We were at 3.6% unemployment. People should have been happier, but no, the inflation was depressing them. In fact, recently we didn't even get back to average again yet, and it's reversed downwards again. Let's talk about inflation. As you can see on this graph, coincidentally, I was just talking about June of 22 with that horrible survey result. Well, look at July of 22 is when inflation peaked at 9% and had been rising very rapidly during that period. And everything was going up. Now, the Fed started raising rates in 22 very aggressively and continued to July of 23. And look what happens to inflation. It's come down significantly. And we had a number this morning. I think it was 3.0%. And month over month, it was slightly negative, which is deflation. But you notice on the right-hand side of this graph now, we've got some things that are going negative, like energy and goods. Goods are what you think, appliances, dishwashers, TVs, things like that. Well, to move those items now, they have to discount the prices. The big one in here that we watch is shelter. Shelter is the dark blue line. And we've talked about this for almost 2 years now. There's a lag effect in the numbers for shelter. Shelter is housing and rentals. And the real-time data has shown that rental prices have stagnated, and everybody's looking at housing. No, housing prices are softening a little bit. Because of that, those numbers are just going to get better for the next 6 months. So the Fed, their target is 2%. We just hit 3% today. We're on our way to probably 2.5% by year end, or near their target, which is good news. It makes the Fed comfortable, and unemployment is only 4.2%, which is historically considered very, very strong. So the Fed is pretty happy about that. Let's look at inflation worldwide. This isn't just a US story. This is what we call a heat map. Make it very easy. Blue means things are cooling, inflation is cooling. Red means it's heating up. If you look at the top 3 lines, the top line is everybody, global. The next 2 lines are developed markets and emerging markets. But as we look at this, pretty much everybody was heated up 2 years ago. They're all cooling down. In fact, the most recent month at the end, May, and the end of 24 basically, pretty much except Japan, all the red is gone. And more importantly, look at China. It's that dark blue one down there. Their inflation is at 0.3% right now. That's almost deflation. China is the second largest economy and one of the biggest exporters in the world. I can tell you this, they're going to have to lower prices to sell more stuff. So they're going to be exporting deflation. And that will be good for everybody, including us, because we buy a lot from them. But let's get back and wrap this up with the Federal Reserve. It appears at this moment, the Federal Reserve has engineered a soft landing. It's hard to do. Most people think it can't be done, but it looks like it's working. So all the stuff we saw on this graph tells us GDP is slowing, inflation slowing, looks like it's under control. The risk for the Fed now is to not wait too long to lower rates. And Jay Powell talked about this week to the Senate, and he's very aware the risk now is keeping rates too high too long, because you could drive us into a recession if you do that. And right now, the federal funds rate is 5.38%. They haven't changed it for a year. They're not going to raise it, but they haven't changed it for a year, and inflation's gone from 5+% down to 3. Well, if you remember what we talked about with nominal GDP, if GDP is 1.5 this quarter and inflation is 3, that's GDP at 4.5%. Historically, if you keep the Fed's funds rates higher than nominal GDP, you drive us into a severe slowdown. So the Fed's position now, they should start lowering rates. Now, on that graph, you notice in blue there, that is the Fed's own projection. They expect to take rates down to under 3% over the next 2 years. The green line is what the market thinks, and the market's pretty much in line with them right now. This will help stimulate a slowing economy because mortgage rates will come down from 7+% to 5% or less. Auto loans have come down. These are all good news. It's not so much good news if you got CDs, because CD rates are going to get cut in half here over the next 2 years. But as far as the Fed's concerned, we got growing evidence. Most of the market was thinking December would be the first cut. After this morning's number, we could easily see it in September. But your next question, obviously, is what does this mean for the stock market and the bond market? And with that, I'm going to hand it over to my son, John, and he's going to tell you what we're thinking.
Great, thanks for that economic outlook. Again,
I'm going to take a second to remind everybody here to submit your questions to service@bullhairwealth.com. Or once again, you can text at 414-644-0060. No questions yet, JJ. So your dad came through with a perfect record. Let's see if you can keep it going.
Perfect explanation. Great. So I'm going to talk about, again, sort of 3 key themes here. One is our bull market thesis. I'm also going to talk a lot about the Magnificent Seven and the state of the S&P 500. And then I'm going to wrap up with the election because, well, we're getting a lot more questions about it lately. So let's go to the very first slide and talk about secular bull market. Are we still in a secular bull market? And I know we've talked about this in the past, but I want to remind people, what is a secular bull market? It's a 10, 15, 20-year uptrend. The 80s and 90s are a secular bull market. The 50s and 60s are a secular bull market. A secular bear market is the 1970s, or in our case, the aughties. From 2000 to 2012 was a secular bear market. And what's different about secular bulls and secular bears is the secular bear, you go nowhere. In 1970, famously, Dow 1000, Dow 1000. The market never made new highs until 2012, from 2000 to 2012. That was a long bear market. Usually during a secular bear, you have one big problem at a time. And in the 1970s, it was energy. In the 2000s, it was the bubble, and then it was housing. During a secular bull market, you seem to have a problem every year, but you forget about it 2 years later. And so we've all forgotten about Zika. We've all forgotten about China slowing down in 16. We forgot about oil in 15. We've forgotten about, to some extent, many people have forgotten how racked we were with COVID. COVID seems to have been a distant memory now. Even the Russian invasion is sort of just part of our everyday lives. So I'm not saying any of these things are good to forget them, but we tend to. Whereas the housing crisis, people remembered it for 5-6 years. It took years to get past it. So we think we're still in a secular bull market. And if we hadn't broken new highs this year, and people might remember this, in the first quarter, we said that typically new highs in the S&P huddle together. And we hadn't had one in all of 22, but we had one in 22 at the very first day, and then it went down. We didn't have any in 23. And we said in 24, we expect there to be 50 to 60 new highs made in the S&P 500. That was our prediction at the start of the year. So far to date, I think it's like 37. So halfway through the year, 37, we guessed, 50 to 60. I'd say that prediction is pretty much on track. What we were concerned about at the time is if we didn't hit new highs, if we started to go backward, we didn't break that 4,800 level in the S&P 500, it might have started a secular bear market. But that looks not to be the case. We're in a secular bull market, and we could probably sustain a 10 to 20%, or easily a 10, but probably even a 20% correction down and still be in a secular bull market from here. So we think the bull market thesis is intact. You know, people forget the 80s and 90s. They always forget the early 90s weren't nearly as good as the late 90s. We're kind of in that early 90s period, if you want to say the history rhymes. And how long in the tooth is this? Well, in 2012, the secular bull market was easy to call, and we were very excited about it. Nobody believed us, but we were very excited about it. That was the first inning. Now we're probably right somewhere around the seventh inning stretch. I mean, we're in the latter innings, there's no question, but the ump has not called the game. We still have some time. We still think there's a lot of room for the secular bull market thesis to run. But how do you make money in stocks? And one of the things we've talked about for years is price to earnings. So price to earnings is how much you're willing to pay for a dollar of earnings. 16.7 is the traditional average. I'm willing to pay $16.70 to get a dollar of earnings each year, and hopefully those earnings grow a little bit each year as well. Well, you want to have fair and reasonable prices for stocks, and that's the price to earnings ratio. And you want to have an improving economy. In 2000, we were paying 24 times earnings. By the way, we're lucky this graph doesn't include some of the NASDAQ stocks at the time. They weren't priced to earnings, they were priced to eyeballs. And this chart would be not, 30x, it would be 3000x because there were no earnings. And we had the shortest, shallowest recession in US history. We went down 0.1%, took 6 months. But we had to reprice everything. We spent years doing it. And that was really the huge fall during that period. 2007, you got cheap prices for stocks, but you had a falling economy. So you still didn't get to win. In 2012, you paid cheap prices for stocks, and you were about to have a 12-year plus run of improving economy. And remember, we said the economy is slowing down. It is still growing. It is still improving at this time. What's got us worried now is we're trading at 21 times in the S&P 500. And I want to put a button in that one because we're going to come back to why we think that's not quite as big of an issue for the broad stock market. But when we talk about earnings, why are we so focused on earnings? It's because earnings are highly correlated to the market returns. So people can talk about how the market doesn't know what's going on, doesn't understand the real economy, doesn't understand returns. First of all, the market's always looking forward. But secondly, there's a 0.97% correlation, or one would be perfect. There's a near perfect correlation between earnings and making money in the stock market. So you want earnings to go up. That's why you want an improving economy. It helps earnings. So if that's the case, those things are highly correlated. They can't diverge for very long. Now, on a daily basis, they always are diverging somewhat. But normally those divisions have to come back together. They have to go back to being perfectly correlated. That's what we know historically. And that leads me to talking about Magnificent Seven and some of the issues we're seeing there. This is a chart of the S&P 500, it's the top 10 largest stocks. And what you'll see, and I'm going to get to what's happening right now in a minute, but in 2000, the market cap kept going up and the earnings actually went down. Well, you can see how this plays out. What happens at the end of it is they have to come back together. Right now, the market cap of the largest 10 companies has gone up drastically. The earnings, not nearly to that pace. And this only ends one of two ways, right? Either the earnings start to pick up, and remember, we just talked about, we expect 14% earnings growth in the fourth quarter. The earnings pick up and they go up to match that market cap number, or that market comes back down to earnings or back down to earth. Either way, it probably means that the top 10 stocks are in a little bit of trouble, especially compared to the broader market. And that's why I want to talk about the broader market as well. So there's a number of different charts here, and I'm going to zoom in on each one. Well, let's start with the very first one is 10 stocks. So we'll zoom in, and 10 stocks are 38% of the S&P 500. By the way, 3 stocks are 21% of the S&P 500. If you were to start a mutual fund today and buy the S&P 500, the regulators would come in and say, do you not understand what diversification is? And you would probably be precluded from a regulatory standpoint from owning the S&P 500 in its current weighting. And that's what we call weighting, is because they are market weighted. The bigger your company, the more you affect the S&P 500. The S&P equal weight index people are talking about the S&P 500 being up, 17% this year. The S&P equal weight is up less than 6. The S&P equal weight from December of 21 at the previous peak is still only up about 1%, 1.5%. So really almost all the growth has come from those 10 names. And the question is it justified in their earnings? So remember, in the 2000s, I hate to always draw everything back to the tech bubble, the top 10 stocks were 26% of the economy, or of the S&P 500. They only represented about 16% of the earnings, right? That was part of the problem. Today, the same top 10 stocks, well, they're not the same stock, but the top 10 stocks again represent 24%, a quarter of the earnings, but they're representing almost 40% of the index. So again, how does this reconcile itself? Well, in 14, 15, and 16, the market actually marked time. People forget that period from March of 14 to November of 16, the market basically just treaded water and went sideways, and it waited for earnings to continue to come up. And as earnings climbed, it justified those valuations that we saw from the market moving very rapidly in 2013. So you can see that happen, but you can also see the market come back down. But interestingly enough is price to earnings ratios, going back to, are you paying fair prices for stocks or not? Well, today, the top 10 stocks in the S&P 500 are trading at an average of 34 times. And if you remember, historic averages are 16.7. The historic average for the top 10 is 20, but we're still trading at 34 times earnings. The remaining stocks, the other 490 out there, are trading at 17 times earnings. So just a little bit over historic average, basically at historic averages. Basically paying fair prices for 490 companies, and you're paying extremely high prices for the top 10. So when I said that the price to earnings ratio in the S&P 500 is 21.4, over 4%, almost 4.5% of it is just the top 10 names making that change, because they're 38% of the overall market cap. As a matter of fact, I think we go back in economic history, this will be one of those periods where we have to constantly put an asterisk in it and say, you can't really count that P/E ratio because it was so concentrated. But that is one of the things we're continuously worried about. So if we continue down, why do we think that this is occurring? We think it's occurring because of a pretty sort of simple chart that we see over and over and over again. This is called the Gartner hype cycle, and it doesn't have any stock charts on it, but it might as well be one, because you see this pattern over and over and over again. A technology is triggered. There's a regulatory change. There's a change in some technology, and it gets readapted, and everybody gets very excited about this. Then everybody's inflated expectations. They realize that it's not quite as great as everybody expected it was going to be. And you start to go through the trough of disillusionment, where this was a useless technology and it never really made any difference. Then you go through the slope of enlightenment and the plateau of productivity. And you can see this over and over and over again. And the tech bubble was the best example of this, right? Everybody put a .com at the end of their name. And that was the technology. We had the internet. We weren't going to need salespeople anymore. We do everything online, which, by the way, is true. But we went through the overinflated expectations. Then we went through the trough. And now we use it probably to its fullest capacity. AI is probably on a similar path. McDonald's recently, 2019, they made a partnership with IBM to join up to replace all of their drive-through order takers with AI. Last week, they announced they're ending that partnership. It wasn't worth the hassle, and it wasn't nearly as effective as they were hoping it was going to be. That's the top end of that chart. That's them going, maybe this isn't as great. I've got 3 people that work here, Amanda, Megan, and Josh. They help make this place run. They're not all getting replaced with an AI assistant tomorrow. We use more AI tools. They'll be more efficient. But the trough of disillusionment is to think that I should fire them all and just replace them with AI assistants. And when that doesn't work out, well, that's the trough of disillusionment. So yeah, we think we're in that cycle right now, and that's for us is part of why this has been overinflated. And as that comes down, we'll see the market change.
So their jobs are safe.
Their jobs are safe. Speaking of, so what happens from here? Well, this is a chart of S&P intra-year pullbacks. And people might remember, I just talked about this in March. Now, during our last chart party, is that I expected the market to pull back 6-7% because I thought it was a little hot for the first quarter. Well, I think the next day it started to decline and we fell 5%. And at the time I told people, don't get out, because we'll probably see net new highs and a broadening over time. Well, that's exactly what happened. The market, we just hit a new high yesterday. The market came back and started hitting even further new highs. What does that hold for the end of the year? We've got half a year left, and there's a couple of options. Last quarter, we saw $9 billion leave the equity market, but the market went up. It just means that there's not a lot of new buyers, but there's not a lot of sellers either. 81 billion went into bonds. It means people are trying to find other places to put their money other than the stocks right now. Well, if that's the case and nobody sells, we'll have a melt up and things will just continue to sort of glide upward. We do have an election coming up, which is what I'm going to talk about next, and that always scares people. So there's probably going to be a correction on that. But if there's not, it wouldn't be a surprise. This is one of those where we're probably overdue for some sort of move downward, but we don't necessarily get it. We might just stagnate and mark time. And it's something we said before. If you mark time, we were flat for 2 years. It's funny, people tend to not be very upset about that as earnings come to catch up. So what exactly happens from here? It's kind of anybody's guess for the end of the year. It's how concerned are we, and some volatility we get from some offside forces, which of course leads me to my next slide is, well, if you don't really know, then you're just gambling, which is the response I get quite often. And the answer is no, but if we were gambling, we're picking the right game. If you look at the odds of winning in a casino, you don't even win half the time. But what's the first thing a casino does when they get you in the door? They do everything they can to get you to keep playing, right? They can pay out some huge jackpots. They can pay out some big hands, but they want you to keep playing because they know the odds are in their favor. That's why they spend so much time working on it. The same is true for the stock market, except you are the house, right? The market can go up 1% or down 2%, down 5% in a single day. You saw it go down 12% back in March 2020. The volatility is still in your favor because you win over time. And this chart is of the Dow over the last 125 years. 99% of the time, 99.9% of the time on a 15-year rolling basis, you make money. Well, basically, I think you got to pull out the Great Depression, and I think that it goes to 100.
Yeah.
But for us, why is it important? You have to keep playing. And the same thing, we just saw it happen, right? We thought a small correction was coming. We fell 5%. We hit new highs 3 months later, right? Trying to time these things is incredibly difficult. So what's going to happen from here? Well, we talked about the economy. The economy overall looks like we're going through a soft landing. Although we're slower, we're going to continue to grow. And if that's the case, and for most of the companies we're paying reasonable prices, there's a lot of room to go upward from here. So we're very excited about what the next 3-5 years holds. But the next 3-5 months, that's going to be tougher. But we know that holding through is probably going to be our best bet. See, going right back to the casino jokes. Mm-hmm. And the volatility, right? The election 2024. This is so exciting. I hate talking about elections. But if you invested, I think people have seen this chart before. You always do better when Democrats are in office, or Republicans are better. Well, since 1953, if you put $1,000 in the S&P 500 and you left it in when Republicans were president for like 20 some years, and you put it in for Democrats for the other 50, 51, I think. Yeah, that sounds right if I add them all up. How did you do? Well, you won being in there with Democrats, almost twice as good. I guess what would have happened if you just left it alone? Going back to that thesis, if we just left it alone, you wouldn't have 27,000 or 52,000. You have $1.4 million. So again, hating the government is not an investment philosophy. It never has been. It never will be. And staying out of the market is not to your favor. And speaking of favor, affinity bias. I think I might do a whole series on biases coming up here soon. But affinity bias is when you think that something's going to go better because you like it. I like the Packers. I bet on them all the time. I don't really actually bet money, but I'm always excited to root for them. I always think they're going to win. Doesn't matter what the odds are going into the game. I have an affinity bias. I want them to win. So I hope they do. And I see all the good things that would lead me to think that they might win. And then when they lose, I'm disappointed. We recognize this in sports all the time, but sometimes we don't recognize it in our politics. You want to focus on policies, not politics. This chart is a chart of sentiment, basically, of what do Republicans and Democrats think at different periods. And if you look at this, when Bush was in office, Republicans thought the economy was fantastic. Democrats thought it was terrible. When Obama was in office, Democrats steadily said things keep getting better. Republicans said we're no better off. Trump gets elected, Republicans think it's the greatest economy we've ever seen, and Democrats think it's not so great. Maybe it's kind of okay, average, and fell slightly. And then Biden gets in office, Democrats think it's great, Republicans think it's horrible. And you can see in this chart, it almost flips on the day of inauguration, which is pretty much impossible. The truth is somewhere in between. And I mean, probably the only time everybody agreed was 2008, 2009. Everybody agreed things were terrible. But other than that, basically, it's if your team is in charge, you think things are great. And that's not an investment philosophy. And even when they say policies, the president, I've never not bought a car or gone on vacation because I hate the president, right? I don't want to participate in their economy. The economy moves pretty much irrespective of the president. And even things that they try to do. Barack Obama famously said he was going to raise the price of oil and make us more dependent on alternative energies, and so that we could help save the planet. Well, he oversaw the greatest expansion of fracking and energy independence in the United States during his tenure. Trump was famously, I think he was a coal burning president, is the word he used. We burn less coal every year while he was president. Joe Biden talked about cutting off fracking in federal lands, like 2% of, I think it might even be less than 2% of federal lands are used for fracking. So it's made no appreciable change. See, even the policies they announce sometimes don't actually have the effects that we think they might. So yes, do tax policies change? Yes, there are policies, not politics. But again, hating the government is an investment philosophy. What's the election going to hold? You notice up until now, I have not said one thing about the election. I didn't say we expect 14% earnings growth unless the wrong person is elected. That's not how I preface that statement. That's our expectation. And the Trump election in 2016 was one of the best examples of that. When it happened, it was a surprise to basically everybody. Well, when people ask me, what do we think now? Our answer is pretty simple. The same thing I thought the day before when I thought Hillary was going to win. The economy was overall great. 2017 would be a great year in the market. We ended up being right. And I think we had a lot less to do with the president than people think it does. So for us, again, summing this back up, the secular bull market still intact. Still in great shape. We're in the latter innings, but we still think there's a lot of room to run. For earnings, the Magnificent Seven, we think there are some problems here. We think it might cause some problems in the upside of the S&P 500, but overall, the other 490 companies look pretty healthy. Their earnings look to expand, and we're excited about that stock pickers market. And then lastly, the elections. I will say it again: hating the government is not an investment philosophy. So with that, I think we're going to conclude, and hopefully this is helpful. If people have questions, I don't know how many came in. I know we're right about the time we're hoping to use.
Yes, we did great on time. We did great on time. Thank you, gentlemen. No questions came through in the queue, but we do want to encourage anyone that does have a question, if you'd like to do so offline, once again, send that forward to service@o'harewealth.com. Just a quick reminder about the August 7th game at the Chinooks. So make sure you RSVP for that. John, did you have a closing thought?
No, just making sure we go through all disclosures as per usual. So
We want to make sure we get the disclosures in.
Yeah, I think JJ did a great job there talking about what we think of the markets. There's no reason to panic here. We've always been against trying to time the market.
Absolutely.
Clearly part of the market's overvalued and needs to either, correct or go sideways for a while.
And by the way, just because you identify that doesn't mean it's going to fix itself tomorrow. The market can stay irrational longer than you can stay liquid. So it doesn't mean that I just because I said this on camera that it's going to deflate tomorrow. It might, but it doesn't mean that it all starts tomorrow afternoon.
Well, in keeping with our casino theme, for those who are in Wisconsin near the Milwaukee area, next week the Republican National Convention starts. So it'll be a good week to avoid it and go to a casino somewhere and have a good time. With that, I believe we're through our slides. Megan just gave me the high sign, so we are through our required slides at the end. Thank you, everyone, once again for joining us. We enjoy doing these quarterly chart parties. Any feedback that you have for us on things we can tweak or add or delete, please submit those to us, and we'll try and do better next time, as we always say. On behalf of John, JJ, and the rest of the team, I'm Jerry. Have a great weekend, folks.
Thanks, everybody.
Thank you.